Okay, so today we are going to start building the valuation model for the semester that we're going to use to do our group projects and many homework assignments, repeatable, reusable model. We're going to use McDonald's as the company that we do it. And to get you started, I posted in Canvas under the Files section a file called Valuation Model MCD Start.xlsx. So you will need to download that file and launch it in Excel. Okay. So what's going to happen is during class today, we are going to start collectively, so you're going to follow along with me in Excel, building out the valuation model. We'll start today, we'll probably finish it on Monday, and then we'll finish up the valuation next week of McDonald's. And your next homework assignment, homework 7, is to replicate exactly what we do in class today. So if you were able to successfully follow along and complete everything we do in class, you can submit at the end of the class and you're done with homework 7 and you'd have nothing to do between now and Monday. Okay? If, however, you can't, then you will need to finish this by next Monday at 10 a.m. Okay? And then we're going to pick up where we leave off at the end of class today, and then we'll pick up on Monday and then finish off the valuation model. Okay? Now, I'm recording this class. I'm posting it on YouTube. So if you struggle and have trouble and need to go back and use that as a reference with the screen capture, you will see that. But as I said, to get you started, you need this file, which is valuation model MCD Start.xlsx. Now, to make life a little bit easier for you, I went ahead and used the template from Bloomberg and I exported the data and I went ahead and put it in the model. So that's a step that you do not have to do. So the data from McDonald's has already been put in using our exportable data template from Bloomberg Professional. Now, in the process of doing that, I did realize that there were 3 additional fields that were not part of your assignment last week that we do need. So at some point, you will need to take your individual Bloomberg template, your custom template, and add those fields in the correct order. And I put them at the bottom of this template so you can see what the mnemonics are. But when we did it on Monday, I forgot to include minority interest, I forgot to include increase in capital stock, and I forgot to include decrease in capital stock, because I quickly found out the model didn't balance without those data points for McDonald's. So I added those in. I put them at the bottom of the list. You'll need to add them to your Bloomberg account at some point before you use this model. But as I said, for purposes of today, the data is there and ready to go. Okay? So let's talk about our Excel-based model. What we're going to do is we're going to create a reusable model that will work for just about any U.S. industrial company, again, service manufacturing, using, and it's linked to this Bloomberg custom exported template, right? And the general idea is the model that we're going to build has a series of tabs that go from left to right. So I'm going to talk about each of the tabs. So first, we have a tab which I'm calling Model-Data, and that's actually the data that's coming from the Bloomberg model on whatever company we're going to value. And in this case, I'm using McDonald's most recent data export. So there's the McDonald's data. Now, this is just from our template for 6 years of historical data. Then, next tab I want to talk about is the income tab. So what I then did is I recreated the income statement data that was exported in a tab called Income. And this is the 6 years of historical income statement data, actually following what was previously the Bloomberg standardized format that they got rid of, and essentially added a couple of items that are now part of their template. And these are the historical years. Now this is going to be a very important tab because this tab has the historical data for McDonald's, and today we're going to create a forecast. Over here on the right is where we're going to actually put the forecast for McDonald's income statement. So this is where the history and the forecast actually meet. Right? The same is going to be true on the balance sheet. So again, there's a tab called Balance Sheet. Again, I took the historical data that we've exported from the Data tab. I recreated it in a formatted balance sheet on this tab. Again, the historical data is on the left. Over to the right is where we're going to create the forecast for McDonald's balance sheet. So we'll have the historical and forecast. Now, the way that we're going to create this is there's going to be a very important tab called Ratios. So the Ratios tab are the historical income statement and balance sheet, not every ratio, but key ratios that will help us as we do the forecast for McDonald's. And in this case, the ratios tab is the one that we will be spending most of our time on when we do the valuations, because as I said, we're not going to forecast the statements directly, we're going to forecast the ratios create the statements. So here's where we can give guidance to our forecast of ratios by looking at the historical income statement and balance sheet ratios for the company. So again, this is really one of the more critical tabs in the model. Over here on the right, there's a tab called TFI. Once we've put in the balance sheet, the TFI reorganizes, and I've already mapped this. So again, what you did in the midterm, where you had to map the TFI, I've done that for you in this model. So this is the rearranged TFI. This is the rearranged TII, the rearranged income statement. And the more important one, here's the CFI. Okay, so I've created missed a reference tab. So if you're following along at home, cell F30 needs to be copied over to G30. When I'd actually had the entire model and I deleted it to get back to the starting point for you guys. So I think I killed a relative reference there. Anyways, the way you do it is just take F30, copy it over one to G30. Again, that gives me my historical CFI, which balances. And then I have my economic profit tab based on beginning of year, end of year. And then I have my ROIC tree, which is automatically calculated for you. Right? And then the final tab that I want to mention in the model is called assumptions. So assumptions are literally that. They're going to be catch-all miscellaneous assumptions we're going to make as we go through the valuation. There's 3 starting assumptions, which we're going to add to the list. And one of the starting assumptions is the last reported year of the company. McDonald's just reported 2014. But let's say McDonald's has just reported 2015. We can come in here, change the starting year, and it'll adjust all the years in the model. Right, and that's what I mean by we want to make the model reusable. So therefore, a couple of best practices to keep in mind as we get started. Number 1, wherever possible, we want to use relative references, not absolute references. Meaning we don't want to hard code in numbers. We want to use relative references because if the data changes, we want the model to refresh. Or if the years change for the same company, we want the model to refresh and reflect the more current years. So we don't want to hard code in 2014 in every single statement because that's going to cause me problems later when it's no longer the 2014 year. So again, relative references wherever possible. Number 2, we don't want to have the assumptions that we change scattered throughout the entire model. Right, and that's just a best practice. Because if you have a very complex model and you have lots of sheets and you put your assumptions on all the different sheets, you will just forget to change everything, right? Because it's just human nature. There's too many things to change. And so what we want to do is we want to limit the places of things that we're going to change. So for our model, we're going to limit those to 2 tabs. Number 1 are the assumptions tab. Assumptions are universal assumptions that are not year dependent. And number 2 is going to be the ratios tab, which you'll see is where we're going to get started in just a minute. But those will be the year-by-year assumptions on the forecasted ratios. Those are the only 2 tabs that we want to have things that change. Right? Otherwise, the model just gets too hard to remember where things are. And I'm going to add the concept of a colored cell, in this case yellow. You can use whatever color you want. I just happen to pick yellow. And the point of the yellow cells is a yellow cell means I can change it. Right? And if it's a white cell, I can't change it. Or I shouldn't change it. Because what I don't want to do is I don't want to break my model. Because a lot of the formulas are going to be key to keeping the model working. So I don't want to overwrite a formula accidentally. So I want to highlight to myself, hey, this is something I can change. This is something I really shouldn't be changing. It's a calculated result or a reference that's being pulled in from somewhere. So I'm going to use yellow cells to highlight these are assumptions that I can change and will be changing when we actually get into the valuation. Okay, so those are just a few words of wisdom as we get started that you should be aware of. Right? Any initial questions? Okay, so let's go ahead and, yes?
When you did that copy over on the CFI, is it a problem that like the cell H17 doesn't actually have anything in it?
Is it a problem at H17?
Yeah,
there's
like
nothing in H.
Has nothing. So like
it's blank.
Is that doesn't matter?
Well, before we finish today, actually cells row 8, column H will have something in it. Okay. So what I had done, to be honest with you, is I'd actually done this in the previous class, and I literally wiped out everything I did, and I restarted. So we're just restarting. So we will end up with data in those cells. We just don't have it yet. That's where we're going to be in the next 30 minutes or so. Okay, great question. Other questions? And again, as we go through, if you're unclear about anything that we're doing or why we're doing it, don't hesitate to ask. All right, so let's go back. Where we're going to start is on the Ratios tab. As I said, this is going to be one of the core important tabs of the model that we're going to build. And as I mentioned, what we're going to do is we're going to use the ratios to help us create the forecast of the statements. Right? So these are the historical ratios for McDonald's based on their data. So here's their historical revenue growth rate, here's their historical EBITDA margin, here's their historical tax rates, etc. Right? So now what I want to do is I want to start creating forecasts for ratios. So first thing I'm going to do is the first forecast year is 2015, so equals previous year plus 1. This is what I mean by relative references. I don't want to hard code a 2015. I want to put a relative reference to 2015, so that way if the model year changes, this will automatically adjust. Okay? So as a placeholder, I'm going to say that the revenue growth rate that we're going to start with McDonald's in 2015 equals 2014 revenue growth. Right? We will change this later, but for now we're just going to leave it as whatever it was last year, equals the previous year, just as we're starting to build the model. Okay? And I'm going to make this a yellow cell because that is an assumption we will change. So in 2014, McDonald's had a 2.4% decline in their revenue. That's history. But going forward, I need to forecast what that's going to be, hence why I'm making that a yellow cell. But for now, I'm just going to leave it at negative 2.4%. Okay? That's one of the first forecast items we're going to make. The next forecast item we're going to make is EBITDA, equals previous year. EBITDA is a critical number that the pros forecast. It's, again, the cash profits of the company. And I'm skipping over the next 3 cells. I'm skipping over cost of revenue, I'm skipping over gross profit, and I'm skipping over operating expenses, also known as selling general administrative. Here's why. I'm trying to make your lives easier, right? Because the number that matters is EBITDA. And you'd have to forecast the components to get to the EBITDA. But to be honest with you, the valuation model doesn't care about the components. Now, if you were working for Goldman Sachs and you were presenting this to who's being acquired today, Kraft, on the acquisition, and you're advising them, then they're going to want to see the forecast for gross profit. Okay, so you'd have to do the granularity. But practically, what we're going to care about in our model is EBITDA. So I'm going to skip over those 3 and just focus on the element that we're forecasting. Okay, so we don't have to really forecast the others because they're going to have to add up to that EBITDA anyways. So I'm going to directly forecast EBITDA, make that yellow. We're then going to directly forecast depreciation, equals previous year, and I'm going to make that yellow. Which means I'm going to solve for operating income, also known as EBIT. Operating income equals EBITDA minus DA. Not yellow. Okay? So that's the point. By forecasting EBITDA and by forecasting depreciation and amortization, I'm forecasting the operating income, also known as EBIT, for the company. Okay? But again, rather than forecasting them separately, one is based on the other. So, and that was a choice that we're making. Rather than forecasting operating income and backing into an EBITDA, we're forecasting EBITDA and backing into an operating income. Right? And that's just a process that I'm choosing, which will make your lives, A, easier, but that's really the way you should be thinking about the valuation anyways. So you'll notice that I had some gray cells over here on the left, and these are probably the 3 most important metrics when it comes to building a valuation model. Okay? So it's really the growth rate, the EBITDA margin, and the tax rate. That's what's going to matter most. And so those are the numbers that we're going to want to ultimately focus on. So back to this. Tax rate. I will need to forecast a tax rate for the company on a go-forward basis. As a starting assumption, what I'm going to use is the average function in Excel, and I'm going to take an average of the previous 6 years. And again, I'm going to make that a yellow cell because if I don't agree with that average as a representative tax rate, I might change it later. But for now, I'm just going to say, let's at least look at what they've been paying on average for the last 6 years as a starting placeholder. Because eventually I'm going to need to figure out what kind of tax rate a company should be paying on a go-forward basis. Okay. Next, my NOPLAT equals, by definition, my operating income times 1 minus the tax rate. And again, I'll make that a percent to 1 decimal place. But basically, that is the NOPLAT as a percentage of sales. Now again, back to the NOPLAT as a percentage of sales. I'm not directly forecasting that. That NOPLAT is going to really be based on my EBITDA and my tax rate. Right? It's going to essentially calculate what the NOPLAT would then be. Finally, non-operating gains and losses equals the previous year. Make it yellow. Those are the key income statement metrics that we are really going to forecast. Okay? Now, I then want to take this, and when we forecast in previous semesters, we actually did a 10-year forecasted model. We forecasted out 10 years. And then, as the book states, year 11 is the beginning of the continuing value period. So we actually did 11 years worth of forecast. But what I found is, particularly with the undergrads, you really struggled with years 6 through 10 in actually coming up with meaningful forecast results. And to some degree, it was almost like a random number generator. So even though we, as I talked about on Monday, we want to basically create something that goes the entire life of a cycle and makes the company mature, right? For simplicity, we're just going to forecast 5 years. Right? It's just going to make your lives a little bit easier. I don't think it's going to affect the quality of the valuations all that much, but it will just make your lives a little bit easier when you're creating the forecast. So you'll be forecasting 5 years, not 10 years, right, of defined period of time. And then year 6 will become the beginning of the continuing value period, which means we need to always do n plus 1 when we forecast. The n plus 1 equals the continuing value period, which means we need 6 years worth of income statement data. So for practical purpose of McDonald's, that means we're going to go through 2020. So what I'm going to do is I'm going to take what we did, I'm going to copy this, I'm going to go to column M, I'm going to paste that, and I now have 6 years worth of ratios forecasted for McDonald's. Okay. Now, final step, I'll come back and talk about this in 1 second. I want to come back to my tax rate because I noticed that my tax rate is the average of the previous 6 years. Now, as I copied that forward, it continued to be the average of the 6 years. So it's like a rolling average tax rate. Well, I don't necessarily want to do that. I want to put more of a representative tax rate. So starting in 2016, second year, equals the previous year. And then I want to copy and paste that over. So for those of you not familiar with Excel, you will be. And just remember to copy and paste. The shortcut on your keyboard, if you have a PC, is Control-C to copy. If you have a Mac, it's Command-C to copy. Right? The paste is Control-V. So you highlight, paste, Control-V. Highlight, paste, Command-V if you're on a Mac. Right? And that will paste. Right? Now, there is one other option I will show you, which is there's the drag option. Whereas if you click on a cell in the bottom corner, the plus will pop up and you drag. Excel will also treat that as a copy. However, I strongly urge you not to do that in this class when you're building the model. Right? And here's why. 95 to 98% of the time, all will be well. However, Excel, Microsoft, tries to be smart. And when you drag, sometimes it says, aha, you're trying to create a series. And you're not trying to create a series, you're just trying to copy and paste. And it doesn't tell you that you're trying to create a series. So what it'll do is it'll create a series. And it'll say, I'm going to keep adding increments to these numbers because you really wanted a series here. But it doesn't tell you it did that. And the way it'll manifest itself is your model won't balance. And it'll be really, really frustrating. Because you'll be like, the model should balance, I don't know why. And you'll go through hours of time. And then what you'll finally realize is that it was Microsoft Excel. Because it treated one of your copy and paste, one of the drags, as a series, and it was trying to be your friend, and it really pissed you off. So I'm just trying to save you hours of frustration that happened in previous semesters over this exact issue. And it may not happen to you, and it may be fine, but I'm just letting you know, when you drag, that's the danger of dragging in Excel. It's a cool feature. It's nice to use. I use it all the time myself. But I'm telling you, when you build a model, dragging is dangerous, because dragging, sometimes Microsoft puts in enough intelligence to do its own thing. And that's dangerous from my perspective. Yes? I9? Sure. Equals H9. Okay? And then just copy and paste that over. All right, so now let's start building out the income statement. I go to the income tab, and what I'm going to do is this tab's not going to have any colored cells on them, so this is no yellow, because I'm not going to eventually change this. This is all created based on the ratios, and it's going to have a lot of data. This is also going to mix historical and forecast data. So what I'm going to do is I'm going to just, for my own benefit, help me highlight that this is the area of forecasted data versus the area of historical data. Okay, because I want to be able to, when I'm looking at this, was this a forecast or was this actual? Okay, so anything 2014 backwards is actual, anything 2015 forward, forecast. Equals previous year plus 1. Again, relative reference for my forecast. All right, and now I want to start building out the income statement. Now, what I'm going to do is I'm going to hide a few columns, just because you don't have to do this, but I'm just doing this so it's easier to see what I'm doing on the screen, in particular in the video, so it's not all squunched over to the right-hand side. So I'm putting it in the middle of the screen. So I'm not saying you should do this, I'm just doing this. But the idea here is I want to start building out the 2015 forecast. So if I go back to ratios, I'm predicting this is the revenue growth rate in 2015. So what I do is I come to my income tab and I say equals 2014 revenue times, left paren, 1 plus, from my ratios, the 2015 revenue growth rate. And then I'm going to highlight this and do formatting for accounting currency, 1 decimal place, just to match the rest of the model. So that's the point. If McDonald's shrank another 2.4%, that would be their revenue in 2015. Now, I don't want you to do what I'm about to do at this point, but this is why we did what we just did. If I go to ratios and I made this positive 3%, then over here, that would be 3% growth. It would then update the dollars in the income tab. So that's the idea. I change the ratio creates the statement. I don't want to directly change the statement. Now, for purposes of matching as we build the model, I'm going to undo that, and I'm just going to actually have the equals negative 2.4% carried over. But that's what we'll get into next week. Is next week we will actually change the ratios and then create something more realistic, which will give us a value of McDonald's. Okay? So these are just placeholders for right now. Now, again, when I forecast, these items matter to the company, but they don't really matter to our valuation, because these are the items that get us to EBITDA. So as I said, to make our lives easier, we're going to directly forecast EBITDA. So how do I forecast EBITDA? Equals my 2015 revenue that I just forecasted, and I'm going to multiply that by my ratios, 2015 EBITDA as a percentage of revenue. So my EBITDA was a percentage of revenue on the ratios tab, right? My 2015 dollars of revenue, I multiply the two together, and that gives me my dollar forecast of EBITDA. You see what I just did? Okay, same thing with depreciation and amortization. Equals 2015 revenue forecast times ratios 2015 depreciation and amortization as a percentage of revenue. Operating income equals EBITDA minus DA. So very quickly, I've created a forecast for operating income, or operating profit. 7761.3. Go back to which one? This one? This is just H8 minus H9. EBITDA minus DA. In fact, you can see over here on the left, pluses and minuses to see what's being added and subtracted. Okay, kind of following this format over here in this column. Which one? This is the ratio for depreciation for 2015 times the dollar amount, 2015. All right, interest expense. What you'll quickly learn is that the forecast for interest expense has no impact on the valuation of the company, right? But we need to have statements that we forecast that look like real income statements. So what we're going to do is we're making an assumption anyways that we're not going to change the debt of the firm, so we're going to leave the interest alone. So whatever interest they're paying, they're going to keep paying. So equals the previous year. Let's keep it simple. You can choose to forecast a percentage interest rate and create an income interest expense, but to be honest with you, it has zero impact on the valuation. So things that don't have an impact on the valuation, I'm not going to waste a lot of time with us trying to create phony forecasts that don't matter, but I am going to put some placeholders in here just so we have balancing statements. So again, interest expense is one of them, equals the previous year. Interest income is another one of those, equals the previous year. Now technically, if I start hoarding a lot of excess cash, I'll probably get more interest income, but as I said, it won't impact the valuation, so therefore I'm just going to put in a placeholder equaling the previous year's interest income. Right? Foreign exchange gains and losses, 0. They're too hard to predict, so therefore we're not going to predict them. We're going to assume that companies are good at hedging, natural or otherwise, and therefore won't have gains and losses. Now again, if you don't like the 0 and you want to create a forecast for foreign exchange gains and losses, you can always do that, but I'll also tell you it won't affect the valuation. Okay, so we're not going to put that in here. Yes?
So did you have it equal to the previous year?
I'm just putting it at 0. Right? Income or loss from affiliates equals whatever it is right now, equals the previous year. So whatever income you get from affiliates, we're just going to assume it just stays constant. Again, it's a non-operating item. It won't really affect the valuation, but nonetheless, we'll leave it there for now. Equals whatever the previous year is. And finally, non-operating gains and losses equals 2015 revenue times, from the ratios tab, 2015 non-operating gains and losses as a percentage of revenue. Pre-tax income. Operating income with all of those pluses and minuses. Now here's a shortcut. I've already done that for 2014. I've added, subtracted everything. So you can just take the 2014 pre-tax income, copy it, and paste that cell over into 2015, and it will calculate it the same way it did the historical data. Or you can follow the pluses and minuses and do it yourself. Whatever your choice is. We're all about choice here. All right. Next, income tax expense. We forecasted a tax rate on the ratios. So what we're going to do is we're going to say, okay, equals that pre-tax income times, from the ratios tab, that tax rate. That will be the taxes that we're forecasting they pay. So income before extraordinary items equals pre-tax income minus the taxes, 4906.7. Yes? Can I go back up to where?
H15.
H15. I just basically said H3, which is the revenue in 2015, times ratios H11, which was the non-operating gains and losses as a percentage of revenue. All right, so from our income before extraordinary items, the next item is extraordinary loss. The key word there is extraordinary. Extraordinary items should be non-recurrent. That's the definition of extraordinary. They shouldn't happen again. Therefore, 0. All right, we're not going to forecast things that shouldn't happen. All right? So our net income before minority interest equals the income before extraordinary items minus any of these extraordinary items that shouldn't happen. Minority interest. These are the dividend payments to the minority shareholders. That's what their share of the income is for the minority investments that we control. So again, we're not going to change the capital structure. We're not going to change the minority payments. Any minority payments continue, equals previous year. Therefore, net income equals income before minority interest minus any minority interest payments. That would be our net income. Next, total cash preferred dividends equals previous year. Whatever dividends they pay, they're going to keep on paying. Other adjustments to equity, 0. These again occur under accounting changes. So accounting changes happen, companies have to restate things. We're not going to forecast those. And they generally don't have impacts on cash anyways. So in this case, 0. We're not going to forecast other adjustments to equity. Yes?
For the income loss from affiliates, did we assume previous year or did we assume 0?
We actually said equals the previous year.
Previous year.
Whatever they get, they're going to keep getting. Income loss for affiliates. Net income to common shareholders. That's the net income after the dividends minus the other adjustments. However, look at cell G25. You'll notice that I add in G23 and then subtract G24, even though row 23 is a subtraction. Here's the reason why. I'm going to copy and paste this over. For whatever reason, Bloomberg gives us dividends as a negative number. All right? It's kind of inconsistent. Sometimes it'll give some numbers as positive, it'll give other numbers as negative. Dividends are going to come in from your data export as a negative number. So if I subtract a negative number, it'll be like adding it. So in this case, we're going to have to add the negative number that's coming from our data export. So that's why I'm actually, even though it says minus preferred dividends over here, we're actually going to add the negative cash preferred dividends over here. Okay? That's their net income available to common shareholders. Same thing. Dividends paid equals whatever dividends we were previously paying. We're not going to change that. This is what I mean. Dividends are showing up as a negative number. So I would normally subtract the dividends, but since it's a negative number, I'm going to add the dividends to my net income available to common shareholders plus that negative dividend, and that would get me my change in retained earnings. So net income minus dividends equals what I would add to my retained earnings. Questions? Yes?
Sorry, I think I missed it. With the total cash preferred dividends and the other adjustments, did you make that?
Preferred dividends equals the previous year. Other adjustments, 0. We're just not going to forecast them.
For the dividends paid,
Equal the previous year. Yeah.
What's the pre-tax income formula?
Pre-tax income formula, the simplest way to do it is just to take G16 and copy it over one. The formula is actually in G16. All right, so final step for the income statement. Take everything you've just done in 2015, select that, all that data, copy it, go to column M, paste it. We now have a forecast for McDonald's income statement for the next 6 years. Right? So that's really the work that we just did. We did this work to create the ratios, to create the forecast for 6 years of McDonald's income statement, which we now have. Right? Which means I can now go to the TII tab, which is my rearranged income statement in an economic format. I can go to 2014. I can copy 2014 out to column M to 2020, and then just change my years to relative references equals previous year plus 1. Copy that out. But I now have balancing TIIs going out to 2020. So all I did in the TII tab is I just copied 2014 because it was all relative references to the income tab. I just copied it out and pasted it 6 more years, 6 more periods. So I now have, like I said, a balancing TII forecast. Yes?
I'm not sure that I understood the tax expense right. Are you saying that it needs to be for each line for each one, or can you go to the ratios?
The tax rate for H9 was the average of the last 6 years. The tax rate in I9 equals H9. Is the 2015 tax rate carried forward for the next 5 years?
And so if you go to J9,
Can I go to J9?
yeah.
Equals I9. So when you copy and paste, it'll do the relative
But
reference.
in TII, I ended up with a different, like final number than what you had, and I all I did was copy it, so I don't know.
For the income tab, do you have 1690.6 as your net income, the final number in the income tab? Yeah, I don't know what you did. We'll have to look at it later. Does anybody else have that problem? For TII, 4700.8? Everybody else have that?
The last year.
Yeah. Okay. Well, just check with me after class. All right. Next, we're going to do the balance sheet. So again, we go to the ratios. These are the balance sheet ratios that we're going to do. So what we're going to do equals the previous year. We're going to make these cells yellow. And then I'm going to copy this. And I'm going to paste this out to 2020 so that all of those balance sheet ratios are just equal to the previous year. Okay, so I just have 6 years worth of forecasted balance sheet ratios, all equaling the previous year. Now, a couple of things. This is where we're diverging from the textbook. Right? The textbook says that a best practice for doing the balance sheet is to tie the ratio with the appropriate income statement item. Which means if I forecast receivables, I should forecast it relative to revenue. But if I forecast payables, I should forecast it relative to cost of goods sold. Okay? So I want to tie the balance sheet item to the income statement driver. Right? Now, here's the thing. We're not going to do that. What we're going to do is we're going to tie every one of those balance sheet categories as a percentage of sales. Right? 2 reasons. One, you don't really get that much of a better forecast by doing it the other way, even though it's kind of a purer way of doing it. And 2, and this is more important, by tying everything to revenue, then what happens is that when we forecast growth, we're actually forecasting growth in the balance sheet as well as the revenue on the income statement. So by tying everything to revenue, we're actually forecasting a balance sheet forecast tied to the income statement. Now, 2 items. One, what that assumes implicitly is a constant level of productivity / cycle time. So we're basically assuming that productivity stays the same. But by doing it that way, what we eventually have to get to is free cash flow. So as the income statement grows, the balance sheet grows. As the balance sheet grows, the delta balance sheet gets me my gross investment and therefore gets me my free cash flow. So the initial assumption we're really making here is that the company is going to grow at a constant level of productivity. If we believe that the productivity should be different, we can go back in and change the balance sheet ratios. But nonetheless, sales activity should drive investment, and that's the way we're actually tying in the model together. Right? That's just a simplifying assumption that we're making, but actually a very powerful one. The other reason why we're doing this is we're not forecasting every balance sheet item because the ones that we're going to care about are the ones that have more to do with the operating capital of the firm, and some of the other items we're going to be less concerned about. But nonetheless, these are the balance sheet ratios that are more important. But to be honest with you, in most of your valuations, you're probably not going to touch any of these. Okay? You're probably just going to let it grow and assume some more productivity in the future versus the past. All right? It only really matters if the company's going to have a huge change in their productivity. Now, let's start creating the balance sheet. So we go back to we have the ratios. We now want to go to the balance sheet tab and start building out the actual dollars. So in this case, I'll start with, and again, I'm just going to, for purposes of seeing it on the screen, I'm hiding, not deleting these cells. You don't have to do this, just so they can all put it on the screen. I don't have to make the font too small. But the first year was 2015, so equals previous year plus 1. And we'll start out with some of the key items. The first item is operating cash. Now, on the Assumptions tab, not the Ratios tab, I have operating cash as a percentage of revenue as an initial assumption. Now, this is what I would call a universal assumption. The Ratios tab is the year-by-year forecast and assumption we're making. The Assumptions tab are things that don't change. Well, we're going to assume that operating cash is always necessary. It's not going to change year by year. There's just a certain amount of cash you need, which is why I put it on the Assumptions tab. Could have put this on the Ratios tab, but as I said, I'm not going to really vary it year by year. So I'm just going to always say it's X% of sales, and I'm starting with 2% as a placeholder, which is 1/50th of the year. So 1 week of sales is operating cash is the starting assumption we're going to make at a minimum. Now, so here's the point. For the balance sheet for McDonald's equals, from the Ratios tab, or I'll start with Income tab, 2015 revenue times, from the Assumptions tab, operating cash as a percentage of revenue, B3. And then, can somebody please shut that door, because I'm actually recording this, and the sound's going to come up on this recording. Thank you. All right, so basically, we're taking the 2% of 2015 revenue, and we're saying that's the operating cash balance for 2015. Okay, so final step here. I want to make Assumptions B3 an absolute reference because I'm not forecasting it year by year. So to make it an absolute reference, which means when I copy and paste, it will always refer to cell Assumptions B3. I put a $sign, or what used to be called a string, in front of the B and a $sign in front of the 3. So this makes it an absolute reference, right, when I copy and paste, as opposed to a relative reference. So therefore, if I copy and paste, it'll always refer to cell B3. Now, next, accounts and notes receivable. This was on the Ratios tab. So what I'm going to do is for 2015 equals, and I can go the other way. I'll start with the Ratios tab, times Income tab, 2015 revenue. Because again, everything's a percentage of revenue. That could be 1185.7. Inventory, same process. Equals, from the Ratios tab, inventory is a percentage of revenue for 2015, times, from the Income tab, 2015 revenue. Other current assets, equals, from the Ratios tab, 2015 other current assets as a percentage of revenue, times, from the Income tab, 2015 revenue. Next, long-term investments, equals, Ratios, long-term investments, times, Income, 2015 revenue. Net fixed assets, equals, Ratios, net fixed assets as a percentage of revenue, times, Income, 2015 revenue. Next item to forecast the ratios is other long-term assets. Ratios, 2015 other long-term assets, times, Income, 2015 revenue. The next one's accounts payable. In fact, I'll go the other way. Equals, because you could do the other way, 2015 revenue times ratio 2015 accounts payable as a percentage of revenue. Other short-term liabilities equals 2015 revenue times ratio 2015 other short-term liabilities. And finally, other long-term liabilities equals ratios 2015 other long-term liabilities times Income, 2015 revenue. As I said, it doesn't really matter whether I start with the income times the ratio or the ratio times the income. Either way, I have to put those two together. That year's ratio, that year's forecasted dollars income, that gets me the dollar amount on the balance sheet for those ratios. All right, so what I now have to do is I have to finish up the balance sheet. Very important that I get a balance sheet that balances. If I don't, I'm never going to have a valid model. So I have to get a balanced balance sheet. So I'm going to tell you how to do that. More importantly, I have to get one that doesn't have what's called a circular reference. If my Excel model has a circular reference, I have an invalid model. Right? A circular reference occurs, and it happens a lot when people create forecasts. Basically, when one cell is dependent on another cell, which is dependent on the first cell. Right? So in order to get balancing automatic financial statements, to get around circular references, I'm going to show you a process that will do that. Right? So it's important to kind of follow this process. So what we're going to do is we're going to basically finish off the liabilities and equity side of the balance sheet first. So let's start filling in some blanks. Short-term borrowings equals the previous year. Whatever debt the company started with is the debt the company will keep. Because again, we're going to assume we're not going to change the capital structure, so we're going to leave the short-term debt alone. Therefore, my total current liabilities will be the sum of the three items above. Accounts payable, short-term borrowings, other long-term liabilities. Again, if you look over the left, You can see what I'm adding up. Long-term debt, long-term borrowings, equals the previous year. Again, we're not going to mess with the debt. Remember, on the income statement, we left the interest expense alone. So, equals the previous year. Pension liabilities, equals the previous year. One of the assumptions we're going to make about pensions is under U.S. accounting law, companies can no longer create long-term unfunded pension liabilities. They've got to fully fund their pensions. So whatever pensions they have, we'll assume is a liability that has to be funded, and any new pension liabilities we're going to assume are fully funded going forward. Plus, most companies increasingly today are not doing pensions, they're doing 401ks and other retirement type opportunities that don't require long-term liabilities. So at best, we're going to assume their NPV 0. So again, we're just going to leave whatever pension liability there is, we're not going to grow it. Equals the previous year. Long-term liabilities, that's going to be the sum of those three items. The long-term borrowings, other long-term liabilities, and the pension liabilities. Total liabilities equals long-term liabilities plus current liabilities. Preferred equity equals the previous year. Whatever preferred shares, they keep, and they keep paying dividends on them. Equals the previous year. We're not changing the cap structure of the firm. Minority interest equal the previous year. If they have minority stakes in businesses, they're going to keep, if they have minority shareholders in their business, they're going to keep those minority shareholders. We're not going to pay them off, other than the amount that's being done in the income statement already. So we're going to leave that stake alone, equals the minority interest. Share capital and additional paid-in capital equals the previous year. We're not going to forecast share buybacks. We're not going to forecast share issues. We're going to leave the shares alone, the common shares, just like we leave the preferred shares alone. Finally, retained earnings. That one we had to solve for. So we know that this year's retained earnings will be last year's retained earnings plus, from the income tab, the 2015 change in retained earnings, which we had calculated, which was the income minus the dividends. So that's how much the retained earnings should change, income minus dividends. So we're going to add that to our starting retained earnings. So we're going to hit the Enter key. Equals last year's retained earnings plus income tab, 2015, change in retained earnings. And then my total equity is the sum of those four items. It's the sum of the preferred, the minority interest, the share cap, and the retained earnings. My total liabilities and equity equals my total liabilities plus my total equity.
Can you go back to H31?
H31 is last year, so G31 plus for the income tab, H31 is the total equity. It's basically summing 27 through 30. All right, so last step for the balance sheet. I got to finish up the assets. And I got to get the balance sheet to balance. So I'm going to show you the trick to making sure your balance sheet balances. We're going to take total assets and we're going to equal to total liabilities and equity. See how easy that was? Balance sheet balances. We're going to force it to balance. Right? Now what that practically means is we're introducing the concept of what's known as a plug. That means we're going to have to solve for one of the asset categories to basically make the assets equal to liabilities and equity. Right? And the plug that we are going to use, what we're going to be solving for, is excess cash. So excess cash is going to be the plug. So everything else we have to have filled in to solve for excess cash. The only asset that we don't have filled in is Goodwill. So what I'm going to do for Goodwill is I'm going to say equals the previous year. It's too difficult to forecast acquisitions, particularly the premiums paid for acquisitions and the benefits of the acquisitions. So we're not going to try. So therefore, whatever Goodwill they have, they keep. And remember, under accounting rules, Goodwill could now theoretically stay on your balance sheet forever, and even when they impair it, it has no cash impacts whatsoever to the business. So we don't really care about the Goodwill. We're just going to kind of leave it there. And we're not going to add to it or really subtract from it because it has no impact on the valuation of the firm. Right? And more importantly, we're not going to forecast future acquisitions because they're too hard to do. And the implicit assumption is if they make them, they're going to be an NPV 0. Right? Actually, what the academic data says is the average acquisition is NPV negative. Average acquisition loses about 5% of the value. So to be honest with you, if we really wanted to forecast acquisition, we'd forecast a decrement to the value of the firm. We wouldn't really increase the value of the firm. What's the number one reason, just out of curiosity, why acquisitions don't create value? You may know? You guys talked about that in your previous classes? Yeah.
Lack of synergy.
It's the lack of synergy, but it actually manifests itself in a different way. It manifests itself in you pay too high a price. So you assume you're going to get the synergies, you paid too high a price, you don't get the benefits, and as a result, the company's not so successful. In fact, I'm literally working on a case study right now of a company that took 7 years to do an acquisition with this other company. 7 years. They danced, they courted, they finally got married. And they didn't get the synergies that they expected, which is very common, right? Because when you're acquiring somebody, you're making a lot of assumptions. And what tends to happen, this is more generic, is that you get optimistic about what those assumptions are and you pay based on hitting those assumptions. But the real world is messy. And in the messy real world, we don't always get those benefits. Sometimes they take a lot longer. Sometimes we run into people and culture issues. Sometimes we run into other challenges that we didn't anticipate. And we often find that things are much more expensive than we thought and take longer, and we never get that price back. And that's why most acquisitions end up failing. It's not that they're bad acquisitions. It's just the prices were often too high because people, as you said, overestimated the synergies. So we're not going to try and do that here in this model as well. We're just going to assume, for purposes of this model, that basically the goodwill stays the same. So now we're ready to plug. So we're going to solve for excess cash because we have all the other asset categories. How do I plug? Equals my total assets minus everything else. Minus my operating cash, minus my accounts receivable, minus my inventory, minus my other current assets, minus my long-term investments, minus my net fixed assets, minus my goodwill, minus my receivables, net fixed assets, goodwill, other long-term assets. Subtract all those. You shouldn't miss anything. And that would give me my forecast for excess cash, 3777.1. Now I'm ready to sum my current assets. And by the way, if you did that and said circular reference, you made a mistake. So now I sum my current assets. Now I sum my long-term assets. And I finish my balance sheet. And just as a quick check, equals my long-term assets plus my current assets. Those numbers should be the same. They should add up to the total assets because I did a plug, so it should balance. All right, you don't have to do that. I just did that as a check. So now we have a balance sheet that balances for 2015. I want to take this, I want to copy it, and I want to paste it out to 2020. So now I have a forecasted balance sheet for McDonald's going through 2020, assuming those ratios come true. So, in about 45 minutes, we've created a forecasted income statement and balance sheet for McDonald's. The forecasted income statement created the forecasted TII. The forecasted balance sheet creates the forecasted TFI. So I go to my TFI tab, I take 2014, I copy it, and I paste that out to 2020. Relative years equals previous year plus 1. But I now should have, if I didn't make a mistake, balancing TFI going through 2020. Relative references. Which means, and this is the key, CFI. I take my 2014 CFI, I copy that, and I paste that through 2020. So I now have forecasted CFIs going through 2020. And again, very important, if I did it right, it should balance every year. Then I go to my EPBOY, beginning of year economic profit. Copy 2014, everything's a relative reference. Paste that out to 2020. relative years equal +1. But I now have a forecast for economic profit based on beginning of year capital through 2020. And finally, EPEOY, based on end of year ROIC, as opposed to beginning of year, which we will use both for our analytics. So again, I forecast out through 2020 equals previous year +1, copy, paste. And so I now have economic profit based on beginning of year through 2020. If you've reached this point, and this number is 2669, and you've reached this point in the CFI tab, you have 3605.7, you've just completed homework 7. You can now save this file. You can now upload this file. You are done with homework 7. If you haven't gotten to this point, you have to get to this point before Monday at 10 a.m. because it will be at this point that we will pick up and complete the valuation model for McDonald's next Monday. Yes? Can I click on which one? BOY? 2625 is the final bottom number. Now, you'll notice that there was a change in equity tab that I skipped over, and I didn't actually forecast this. Here's why. The reason why we had to add to the data tab these 3 numbers down here at the bottom is because McDonald's has been both issuing shares and buying back shares simultaneously for the last 5 years. So what I actually had to do is I had to make adjustments to the equity to account for the issues and the share buybacks. That's what the change of equity tab was doing. It was solving for these adjustments to equity to keep the balance sheet and therefore to keep the CFI in balance. Now here's the thing. Going forward, we're not forecasting share buybacks. We're not forecasting share issues. So that's why I'm not worried about it in the future. All right, but I did need it for the past because the company was issuing and buying back stock. That's actually the 2 data points that I forgot to add to Monday's assignment that I had to add to this assignment, plus the minority interest total amount. So that's why I added those to the bottom of that list, which you will need to add to your model, by the way, in that order. Yes?
Why is it that the CFIs are the same?
That is an excellent question I was about to ask. That is a perfect final exam question. Right? So, his question was, and this is where I actually ended the last class, it's a great question. So, if you look at the CFI tab, between 2015 and 2020, the CFI does not change. Why? Yes?
Because your assumptions of growth and your spread aren't changing.
That's not the reason. Why is the CFI not changing? Yes?
Because you copied all the balance ratios.
That's also not why it's the answer. It's not the answer. Just conceptually, why does the CFI stay the same? What is CFI? Cash flow available to pay out to investors, which equals the actual payout to investors. Are we changing the payout to our investors? No. We're leaving the payout identical. Whatever dividends, we're leaving alone. Whatever interest, we're leaving alone. We're not paying off any debt. We're not issuing new debt. We're not issuing new shares. We're not paying off shares. We're not changing the minority interest. So basically, whatever they're paying out, we're leaving constant. That's why the CFI is staying constant. Now, here's the thing. As somebody pointed out a second ago, but the company's income statement is changing. But the payout's not changing. So where do all the cash profits that McDonald's makes, where do they show up if we're not paying it out? It's not retained earnings. Cash flow. Excess cash. So what you will see is an increase in excess cash, and if you go back to the balance sheet, what you'll see is this excess cash balance for McDonald's goes up. So what we are forecasting, so again, this is why it's such a great question, because it illustrates a very important point to the model. We're not forecasting what McDonald's will buy back in shares. We're not forecasting the dividends they pay, but what we're forecasting is the excess cash that could be one of those. So that's the point. The excess cash balance in our model, non-operating asset, is the discretionary free cash flow that can be paid out. So that's the point. You either pay it out or you put in your excess cash. And so at this point, it's hard to say, is McDonald's going to raise the dividend or is McDonald's going to buy back shares? We don't have to have that conversation. What we know is that they have $13 billion by 2020 that they can distribute, assuming that this model comes true, which shows a shrinking McDonald's with not changing margins. But the point is, that is the cash that can be distributed. And that's what matters to us from a valuation standpoint. That's their discretionary cash. And that's why the CFI doesn't change. If I really wanted the CFI to change, I could start forecasting a change in dividends. That would cause it to change, right? But I'm not doing that, right? We're just forecasting the cash that would be available to pay the dividends. And when we do the valuation on Monday, it will make more sense because the way we'll do the valuation is we'll value the operating cash flows and then we'll value the non-operating cash flows, and that $13 billion of excess cash is going to show up as non-operating cash flow. Yeah. You don't have to. And that's what I said earlier. The reason you don't have to forecast the change in equity is because this only matters to adjust the equity when we're issuing and repurchasing shares, which McDonald's did historically, but we're not forecasting any share buybacks in the future. We're just forecasting the excess cash instead. So we don't have to worry about copying and paste in the future. You can. It'll all be zeros. Right? Really good questions. All right. So, again, what you need to do, save, then go, assuming you've done, go to the assignments, go to homework 7, upload your Excel file, and enjoy your weekend. All right? So this is homework 7. If you're done, you don't have to do anything until you come back on Monday. If you're not done, you have to get to this point by Monday at 10 a.m. We will pick up at exactly this point on Monday and finish out the model. Yes?
Can we just see the EP end of year?
For which one? Which EP you want to look at?
The end of year.
Oh, end of year EP? All right. So here's the other thing we're going to do on Monday. Monday, we're going to pick the companies for your valuation group projects. Okay? So you'll pick the industry. I'll give you the industry. You'll pick the companies in the industry you're going to do your group projects on. All right? And then this model, which we will finish up evaluation of McDonald's next week, will be the model that you use to do that group project valuation. So you're actually building this. And then there'll be coming up homework assignments in class. We'll do other example companies. So we're going to do a lot of practice with this once we finish out the model. All right? Other than that, we are done for the day. I will post this on YouTube if anybody is struggling with this and needs this as a reference. Otherwise, have a good week.